can I increase my loan when I refinance? And the answer is yes, most of the time. And this is actually majority of the reasons people do refinance is to increase their loan. In this video, I'm going to talk about how it works, some pros and cons to doing it, and of course, everyone's situation is different, so make sure you talk to your own mortgage broker or planner when discussing your own financial needs. So how it works is, let's say your old loan is, say, $600,000, and let's say, it was Christmas or you had some school fees and you didn't quite have the money for it, and you have some credit card debt or consumer debt, we call it. And it's killing you, the interest rate's 20% and your mortgage is 6%, and you're like, I just want to wrap this up into my mortgage to try and lessen the financial burden of these really high interest rates. You can do it, all right? But a couple of things you want to check first is you want to keep your LVR under 80%. Now to work that one out is pretty simple. You got to get your balance of your loan and you need to divide it by the value of your house. So let's say your loan is $600,000 and let's say the value of your house is $1 million. 600 divided by 1 million is a 60% loan to value ratio. So when you are looking to increase your loan, you want to stay under 80% because anything above 80%, you have to pay this thing called lender's mortgage insurance, and it could be thousands of dollars and outweigh the financial benefit of increasing your loan. Let's say someone's loan was $600,000. They had a credit card of, say, $20,000 they want to wrap up. Let's say they had a car loan paying 9% of $30,000 they want to wrap up. And let's say that they really want to upgrade their kitchen and bathroom because it's really old and the house has gone up in value so much and they just want to do it. And that's going to be another $50,000. So this is probably what we'd look at doing. And again, everyone's situation is different, but stick with me. These two here are 100% with the house. So what I would do is I would go $650,000, okay, as loan A. If their loan had 25 years remaining, I would suggest to the clients trying to keep the loan term the same, because we know if we go over 30 years, you pay a lot more in interest. So we might do this one, a 25-year loan and principal and interest. Now, we've got some consumer debt here. So these ones here, the credit card and the car is consumer. Now, credit card, I don't really want to be putting on a 25-year loan, and that car loan probably only had 6 years to run. So what I would do is talk with the customers, see what they can afford, and try and wrap those two loans into one. So for example, those two loans are $50,000. I would probably do a 50 grand loan. Of course, and we'll call this loan B, we need to do principal and interest, but I might do that one over 5 years to really pay it off faster. Not only have I increased the loan, gotten rid of paying some really high interest with the credit card and the car loan, I've actually been a little bit even smarter, and rather than put it all into one and pay it off over 25 years, I've put those consumer debts into a smaller loan term. But yeah, you're going to be paying 6% versus 12. So this is how it works. Some warnings. Don't, of course, refinance if you're not going to be financially better off. And hopefully you've learned something. If you do, please follow my YouTube channel where I talk heaps of stuff about this. Thank you.